Here the playground is a here the playground is a business world, business platform. So the main boost of privatization competition is entry of many players in a product and production process, competition increase, and through a challenge to produce perish. And next, one more is consume benefits. So consumer benefits are like to gain as product quality and post or after sale service improve in a contrast to the utter neglect of both in the earlier public sector. Next, disinvestment commission. We have few commissions in privatization. Let us discuss a few disinvestment commissions and what is a disinvestment commission. As per the meaning assigned by disinvestment commission, there is no difference between disinvestment and privatization. Some countries avoided the word privatization. Countries like Australia and it termed privatization into a prioritization, like countries like Bolivia, it mentioned industrial transition, and Chile, popular capitalization. Sorry for the interruption. Uh, Disinvestment Commission. Let us discuss Disinvestment Commission. As per the meaning assigned by Disinvestment Commission, there is no difference between disinvestment and privatization. Some countries avoided the word privatization. For example, like Australia used a term like a prioritization, and Bolivia kind of countries industrial transition, and some other countries named their privatization into some other meaning form. And disinvestment commission, coming to disinvestment commission, the budget speech of 1996 to 1997 announced the setting up of disinvestment commission for advising on the disinvestment related. And coming to a national investment fund, here national investment fund is it was set up in 2005, and the purpose of fund was received disinvestment procedures of central public sector enterprises and to invest the same of generate earning without depleting the corpus, which is permanent. So 75% of annual income of NIF would be used to 104 finance, selected social sector, scheme education and health, employment, and the rest 25% to meet the capital investment requirements of profitable and reliable CPSCs. And coming to public-private partnership, also called 3Ps, public-private partnership. This is nothing but, as the very name suggests, that public-private partnership is a partnership between public sector unit and private entity, public sector unit and private entity to provide public asset or serve based on per contracted terms and conditions. So here few models about 3Ps like public-private partnership. Today there are various models like BO, build, own, operate. So like building, own, operating methods. Like in this method, new units undertaken by the public sector are given into private sector to build them with own investments and ownership with a freedom. And coming to build, own, transfer. So here, if we discuss building, own, transfer, in this case, private sector invests, operates for some times and later transfer to government. And next, build, own, lease, transfer. They will build, own, and later they will lease or they will transfer. The private sector invest and leases to a government, and then at later date the ownership is transferred after receiving due compensation from government. And next, build, own, share, transfer. Next is a build, own, share, transfer. This is in this form, private sector investment owns and shares with the government and financially transferred to government after receiving costs. So let us move on to our next picture, which will show how public and private partnership have infrastructure like planning, financing, designing and building, operating and maintaining. This picture will reflect what exactly a public-private partnership in infrastructure. So next, move on to globalization. Till now, we discussed liberalization, privatization. Next, let us move on to globalization. What exactly a globalization meaning, and a few other parts in a globalization. This picture, which I shown on a screen, will reflect what exactly a globalization. Like culture, different type of cultures and different products and different services, technology, people, information, and capital. It is a integration of globalization is integration of all these measures, like different people will integrate, different capital will integrate, and different informations also will integrate, and technological products and services culture will integrate. Integration of one economy with the economies of rest of the world so as make it look like a global village. This picture will reflect how global village will look. And next, if we move on to discuss for a removal of barriers on the movement of goods and services, resources, both physical and financial, technological, etc. So if we move on to globalization, this globalization will integrate the economy, different economies on a single platform. And also, this will remove the barriers through movement of goods and services from one country to another country, and the resources from one country to other country, like imports and in the form of imports and exports, and also physical and financial. Physical, nowadays, many people are migrating from one place to other place, from one country to other country. The main purpose of this migration is to earn or to for a purpose of job or employment. Of course, higher educations, many people are moving. But this globalization platform is a platform which is helping such people and such industries uh, as a barrier. And next, in other words, a free flow of goods and services across the world is called globalization. Very simple. From India to other country, or like United States or United States of America to India, or else United Arab countries, we are importing kind of petroleum and diesel. So these things we are importing from United Arab countries because they have a number of resources. They are exporting from their country to India. Here we are importing. So we got very easy access with the platform of globalization for imports and exports. So this globalization will make a free flow of goods and services. Of course, countries have tariffs and their taxes and custom departments and their own rules and regulations. But still, uh, we this globalization platform is providing a free flow. And next, government policies towards globalization. Government policies. The government policies have started in 1991. 1991 policy dealt with the following measures towards globalization. The main policies are like import liberalization, as I mentioned earlier, import liberalization. So The government of India permitted import capital goods and intermediate goods and raw materials, except the restricted imports. Like for example, gold has a restriction from importing from other countries. There are few dedicated things and high expensive things which are having restrictions, and apart from that, it is permitted, India is permitted imports of capital goods like intermediary goods and raw materials, except the restricted imports. Like restricted imports are like gold or some other expensive things. And next, the peak rate of customs duty on non-agricultural products has been brought down from its peak of 150% in 1991 to 92 to 40% in 1997 to 98, and also to 98 20% in 2004 to 2005 to 10% in 2007 to 8%. So this statistical information will reflect how Indian government is permitting. And next, foreign investment policy. This is one more government policy towards globalization. First one is a import liberalization. Next one, foreign investment policy. Foreign investment policy is foreign direct investment, like FDI we call, and foreign institutional investments, FII, has been drastically altered in aftermath of 1991 industrial policy. This policy, at present, foreign capital is allowed up to 51%, 74% and 100% of equity in different industries based on their priorities. Next, move on to exchange control. Another one is exchange control is in India. It had adapted fixed exchange rate policy and restrict exchange control and direct and indirect for long. And next, in 1973, Foreign Exchange Regulation Act, FERA, was passed, preventing and regulating the use of foreign exchange. In 1973, FERA, Foreign Exchange Regulation, it passed the preventing and regulating the use of foreign exchange. And in mid-1980s, it was diluted in limited way, and the post-liberalization reforms made FERA irrelevant. In fact, FERA was replaced with FEMA in 2000. FERA and FEMA. And next, let us discuss liberalized exchange rate management system. What is liberalized exchange rate management system? Let us move on to the topic. It was yet another initiative taken up by the government to boost export. So mostly from India to other countries, we have more imports comparatively exports. So this LERMS, Liberalization Exchange Rate Management System, is giving a kind of boost to the exports. And next, it was introduced with the effort from 1992, and 1992 it was introduced. And this system introduced dual exchange rates to give an incentive to earn a larger amount of earning to the exports and recipient of foreign exchange. Under 40% of exports are earning converted into rupees at the official exchange rate, and the remaining 60% at the market exchange rate, which is higher than the official exchange rate. So with the liberalized exchange rate management system is helping the exports, more exports flow by providing extra percentage. And next, let us move on to Indian financial system. reforms in financial sector. Till now, I explained about. Let us go back. Till now, I explained about liberalization, privatization, and globalization and their policies. What is a liberalization? What is globalization? And what is a privatization? And the importance of these three things, LPG. This is also called as LPG. And I explained about few policies and few standards and objectives about this LPG, liberalization, privatization, and globalization. Let us move on to Unit 7, Indian financial systems and reforms in financial sector. First, before entering into our industrial finance system, let us discuss what is the exact meaning of Indian financial system. A system that enables the exchange of funds or financial services between the suppliers of funds and the borrowers is called as financial system. Very simple definition: exchanging of funds between two countries or two people or two businesses or two international businesses. They will exchange the financial funds. So it might be in a form of liquid cash, or it might be a form of transferring of their investment. Next, constitutes of the financial investment. Here I shared how financial system will work. As I mentioned, financial system will work like it has three types. Financial assets are instruments. Assets are instruments, both are same. Like financial markets, and next to financial intermediaries. First one, assets, markets, and intermediaries. And next, under financial markets, we have different types: forex market, capital market, and money market and credit market. These are the few platforms. And next, coming to primary market, we have again a secondary market. We have primary market under money market and capital market. Next, move on to financial asset or financial instruments, which is having money market instrument, capital market instrument, and hybrid instruments. So this is a financial system, how it will affect. This flow chart will give us a clear picture of financial system. Let us move on to financial institutions. Financial institutions are like banks, financial markets. Those who are nothing but financial institutions. As I mentioned, these are establishments that transact in money in the form of mobilizing, saving, and leading them to the needy, mainly consumers or investors for a gain. And next, financial market. This is a financial institution. And next, move on to financial market. In India are classified as money market and capital market. Money market transact in a short-term claims and gains money, while the capital market transact in a long-term claim against market. Next, a third one is a financial instrument. As I mentioned, this is a first type. An important component of financial sector is financial instruments and products which are to be treated in the financial market. Next one will be financial services. Financial services are here, if we observe, the financial services are banks, like agencies, commercial banks or investment banks, insurance companies, acceptance houses, and also discount houses and credit guarantee houses and credit rating agencies and leasing companies, mutual fund houses, and merchant bankers and portfolio managers. So these were financial services. Next, move on to financial institutions. What are the financial institutions? As I mentioned, this picture will reflect the financial institutions like commercial banks, investment banks, and credit unions, insurance companies, and brokerage firms. Nowadays, if we observe one outside of the market, we can see many commercial banks are there, investment banks and credit unions, insurance companies like LIC is a major insurance company and brokerage firms. These things we can see in a market. Next, banking institutions. Here I mentioned as central bank, Reserve Bank of India. In India, the Reserve Bank of India is a central bank, as I mentioned. So Reserve Bank is nothing but a central bank of India. It established as a private sector bank by RBI, Reserve Bank of India, Act 1934, and stated functioning from 1935. So it was nationalized in the 1949. Here we need to remember 3 years. It is established in 1934, started functioning in 1935, and nationalized in 1949. The central bank discharges the functions of issuing uniform currency. So this will issue the uniform currency, banker to government, and bankers bank, and lender of last resort and controller of credit. Next, move on to commercial banks. Now we had seen as what is exactly a central bank. Next, we have commercial banks. These are considered as the nucleus of the money market. They are the connecting bridge between the servers and investors. They mobilize the dormant savings from the hand of public through current saving time and cumulative deposits. Next, move on to non-banking institutions. If we see this institutions were the banking institutions which I shared. Let us move on to non-banking institutions. Those were central banks like Reserve Bank of India in India. Reserve Bank of India is a central bank established, as I mentioned, 1934 and function. And next, non-banking institutions. Here the picture will reflect a non-bank financial institution. Like non-bank financial institutions are insurance companies, venture capitalists, and private equity funds and investment banks, hedge funds and bond shop, and next currency exchange. These were the non-banking financial institutions we observed. So apart from banks and number of non-banking financial companies that are operating in the Indian financial system. These non-banking institutions are operating the Indian financial systems apart from banking. So the NBFCs are registered under the Companies Act 1956, Reserve Bank of India, Amendment Act 1997. There were different types of NBFCs, non-banking financial companies. First type will be equipment leasing companies, which carries on the principal business, the business of leasing of equipment on the financing of such activity. And also we have different types, as I mentioned. It has the purchase financing companies, provides term loans for purchase of producer goods or consumer goods and services with installment repayment system. Next, housing financing companies finance acquisition or construction of houses, including plots of lands or construction of houses. So there also were other types, but I'll move on to financial markets. What are the financial markets and its functions and classification? Here I shown a picture on financial markets. What exactly a financial market? It refers to the marketplace where buyers and sellers participate in the trade. Very simple. The financial markets are the platforms. Financial markets are the platforms where buyers and sellers participate in a trade. That is nothing but financial market. And it is a platform that facilitates the traders to buy and sell financial instruments and securities like shares or investments or trading, mutual funds. There were number of types of financial investments. These financial markets are providing their platforms different with the different names. Let us see what is the importance of financial markets. Financial markets will helps economic growth of country, of course, investments. For example, if we take foreign direct investment, other country people will show interest on investing in our country. So they will invest in our country as per our interest rate of market, and it also helps South to become investors. So financial markets also will help South to investors, and also it helps business to raise money to expand their business. And next, functions. If we see functions, financial market functions, price determination, mobilization of funds, ensure liquidity, save time and money. These are the financial market functions. And let us see types of financial markets. Here I mentioned nature of asset. So what type of asset, either liquid cash or gold or silver or in a form of online gold investment. So anything you can take like land or vehicles, anything is investment, I mean asset. So nature of asset like stock, bonds, commodity, and derivative market. And nature of claims, how we are going to claim. Equity market and debit market, and maturity of claim, either it is for 1 month or year or decades. Money market and capital market. And next, delivery time, cash market and future markets. These are the delivery times. Either it is in a form of cash market or either it is in a form of future. Next, organizational structure, exchange, traded market, and over the counter. These are the functions of financial market. If we observe what is a financial markets, it is a platform. Financial markets are platform for buyers and sellers to participate in a trade. And I mentioned importance and functions and a few different types of. Next, let us move on to instruments of money market. Instruments of money market. So in this first instrument is like if we observe bills of exchange or commercial bills, these are the bills generally emanating from trade domestic as well as international. A bill of exchange is drawn by one party called as the drawer to another party called as drawee to repay a specified amount either on demand. So that is called side bills, or on a specific date called term bills. We have called side bills or called term bills, and also these bills normally have maturity period of 91 days plus a grace period of 3 days. So unfortunately, the market for bills of exchange is not as well as developed as in developed money markets. Next instrument is treasury bills. So treasury bills and ad hoc treasury bills are drawn by the central and state government and discount them with commercial banks and financial institutions. These treasury bills have specific maturity duration of 91 days and 182 days or 364 days. So it have a maturity duration of 91 days and 182 days or 364 days treasury bill. And they are also called as self-maturity papers as they can be. liquidated very quickly. And next, move on to certificate of deposit. This is one more instrument. Certificate deposit. So certificate deposits, it is like a bank deposit receipt issued to the bearer to receive interest. And the certificate of deposit clearly specifies the date and the amount to be rapid. And normally maturity period varies from 3 months to 5 years. The investor in this certificate of deposit receives higher yield compared to bills of exchange and treasury bills by they are risky investments in a prone for default. Next one is next instrument is a commercial paper. So these commercial papers are low cost alternative to investors and trade mobilized funds and also loans on the security. So they have maturity period of day 1 to 270 days, and they can be disconnected through money market financial institutions also. And also risky investment will give a higher returns. Of course, in a market, high risk, where there is a high risk, high returns. Low risk, low returns. So this is a funda of commercial papers in a commercial market. Next instrument is repurchase agreements. These are the agreements which facilitates bank to sell or borrow the RBI or other banks. And in a simplified terminology, when banks borrow from RBI, they have to pay repo rate of interest and they keep either cash with the RBI. They get reserve repo, so reverse repo rates. So the difference between repo and reverse repo will be 1 by 4% to 1 by 2%, 1 by 4th to 1 by 2nd. Next, banker acceptance. This is one more instrument. A banker acceptance is a short-term debit instrument issued by the company that is guaranteed by the commercial banks. These are a few instruments, and the maturity period of this banker acceptance will be 30 days to 180 days. And also it is negotiable. And coming to our capital markets, what are the capital markets? Capital market, as I shown the normal definition with a picture. Capital market is a market for long-term securities. It is only for long-term securities that include both debit and equity. So companies and governments can raise long-term funds more than 1 year. So long-term funds are more than 1 year through this market, and capital market channelizes the funds from those who have excess capital to those who need it. And here I mentioned functions of capital markets, saving mobilization, formation of capital, rapid economic growth, benefits to investors and variety of services, and the continuous availability of funds. These are few functions, and let us discuss types of capital markets. There were primary and secondary markets. So under primary, public issue, private placement, and right issue. And under secondary market, we can see over the current counter market and tailor markets. These are the two types of markets. So till here, we completed Indian financial systems and reforms in financial sector. So I'll give a brief on today's topic. Unit 6, liberalization, privatization, and globalization. What is a liberalization? And I just mentioned what is a liberalization. And here I mentioned when it started like economic reforms. I have mentioned structural reforms and stabilized measures. In a structural reforms, we have private and liberalization and globalization, LPG. Again, we discussed what is the need of it and what is the main goal of it. And next, privatization. Here I mentioned a picture, government and public entities will become, or it turns into a private owned. are managed with enrolled entities. That is nothing but a privatization. So I gave a meaning and few adjectives on privatization. And also we discussed a little bit about benefits of privatization. And next move on to national investment funds and public private partnership, 3Ps. This is most important topic in privatization, public private partnership, PP, and types of PP, 3Ps also more important. And here, public-private partnership infrastructure I shown like a planning, finance, design, building and operating maintenance. This is a public-private partnership in industries. And next, move on to globalization, and it's more like a globalization. With this picture, we can understand that what exactly is globalization. So integration of products and services, culture, information, capital, people, and technology. So integration of all those things in one economy with economies of rest of the world. So make it look like a global village. So with my picture, I can tell you this shows a global village. And next we discussed kind of government policies towards globalization, like important liberalization, some other policies of foreign investment policies, FDIs, foreign direct investments, and also exchange control and liberalized exchange rate system, LERMS. This we discussed. And next, we discussed about Unit 7, Indian financial system and performance in the financial sectors. So, Indian financial systems and reforms in the financial sector. Meaning, I discussed what is our Indian financial system. And also, I discussed about constituents of the financial systems. This picture will reflect what is a financial system and financial asset instrument, financial markets, and what are the financial intermediaries. This we discussed. In these mostly financial institutions, financial markets, and financial instruments. What are the instruments and services, financial services? And also this picture will reflect what are the financial institutions, types of financial institutions like commercial banks, investment banks, credit unions and insurance companies, brokerage firms. These are the institutions which I say. Next, banking institutions and non-banking institutions that I discussed. In a banking institutions like the Central Bank of India, Central Bank, that is nothing but Reserve Bank of India and commercial banks. What are the commercial banks and non-banking institutions? This picture will show how non-banking institutions are running the Indian government, Indian financial system, not government, Indian financial system. And we also discussed few types of non-banking financial systems we discussed, and also kind of classifications. Financial markets, what are the financial markets and importance of financial markets, and functions and few types of financial markets. And later we discussed instruments of money market. These are few instruments: bill of exchange, commercial bills, and treasury bills. And next we have a certificate of deposit and commercial papers and repurchase agreements and bankers acceptance. Next we discussed capital market. What is a capital market and what are the functions of capital market and types of capital market? Till here we discussed. If you have any doubts, you can ask me. Thank you. Thank you so much for your questions. Next, let us discuss about political and regulatory environment, which is a third block. Political and regulatory environment that we will discuss in our next class, further class. In that political environment, we have Consumer Protection Act 1986 and Foreign Exchange Management Act 1999. So these three topics we'll discuss in the later classes. Thank you so much.